In this video, I'm gonna change your financial life. I'm literally gonna put you back in control of your money, and I'm gonna show you how your money will work for you 24/7 without you working harder, longer, or taking on any risk. I'm gonna show you a concept that needs to be applied in your family's financial picture, because if you don't, you will continue to be a slave of the financial system for the rest of your life. Let me explain to you what the infinite banking concept is, how it works, and how it's going to solve your financial problems. Let's dive in. A lot of people mistake the infinite banking concepts for a product. They think it's all about a whole life insurance product or life insurance, but what it's really about, it's about taking back the banking functions in your life. It is Banking 101. So that's what I want to talk about today. I want to talk about the infinite banking concepts, what it is, how it works, and how it can solve your financial problems. But in order to explain the infinite banking concepts, I first have to take you back and explain to you banking. Because I know you think you understand banking, but a lot of us, we have forgotten how much control we give away to the banks. And I want to just bring that front and center with a very simple explanation of how much you don't know about traditional banks and what they're making on your money that you give them. And you do give it to them, and you do give up control of your money the moment you make your deposit. So let me show you. You take your money, and these are just examples, but let's just say you take $100,000. Now, I don't care if it's $10, $100, $1,000. We're just doing this as an example. And you find a traditional bank that will pay you 4% on your money. Now that would be pretty nice, right? Some of you may have high yield savings as of right now, March of 2026, where you're getting 4%, but most of you are making less than 1% on the money you put in the bank. So this would be a really good bank. You put your money into the traditional bank. That feels good to you, doesn't it? Gosh, we love making deposits. You put the money in the bank, you feel like it's yours, you can go back and access it anytime you want. But what's really happening? Well, you are creating an asset for yourself, because that deposit you make is an asset on your balance sheet, on your personal financial statement. But to the bank, that deposit, it's a liability. But you see, the bank does something really smart. They immediately take your deposit, which is a liability, and turn it into an asset by making a loan. Now, let's just talk about loans, right? We all have gone to a bank and borrowed money for cars, for houses, for whatever. You finance everything in your life. And actually, let me explain something to you that R. Nelson Nash really did a great job of explaining in Becoming Your Own Banker. The late R. Nelson Nash said, you will finance everything in your life by either giving up interest you could earn on money, or by paying interest on the things that you buy. Now, how do I explain that? This 4% is interest you are earning on your deposit. But this person right here, who is buying a home, borrowing money from the bank, they are paying interest to the bank in the form of principal and interest monthly payments. So either way, you're giving up interest, because if you paid cash for the house, you no longer earn the 4%. You put the money in the bank, you save it up, you then take it out and you buy the asset or whatever it is you buy. You no longer earn interest on that original sum because you had to withdraw it to buy the asset. Understand? You gave up the interest earning potential of your money. Or you finance it, like this example with the bank, and the bank charges you interest, in this example, 7%, and you're making interest payments to the bank. Now, we're not going to get into the semantics of that. I just want you to understand you are always giving up interest, whether you're paying cash or you're financing. But let's get back to how the bank really controls your money. Because when you put that money into the bank and the bank lends that out, the bank turned it into an asset. The loan is an asset to the bank. So therefore, now the bank is on the right side of the coin, and it's an interest income for the bank. But the bank only owes you 4% on the money you deposited. The bank uses your money to lend it out at 7%, effectively making a spread on your money with very little risk. How much risk did they take? Well, they had to underwrite the deal, the piece of real estate. They had to underwrite the borrower, but they've got a first lien position on that house. So if that person stops paying, the bank owns the house. They foreclose on it. So very little risk is taken. And also, when I talked about control, did the bank have to call you and ask to use your $100,000 deposit to lend out on this house? No, they didn't ask you at all. No phone call, no email, no text, which means it's not your money. You gave up control. That's the only point I'm trying to make. But the banks have done such a great job of convincing us that this is okay. This is just how it happens. This is just what we're supposed to do. So what happens then? Well, the seller of the house gets the money, which was issued from the bank, which was given to the bank by you and all of us, the depositors. And the seller does what they've always been taught. Deposits the money back in the bank. Now the bank's got another problem here because now the bank has another liability because the seller has an asset. They immediately flip that sucker around, lend it out on this beautiful BMW car over here, and they charge 8%. See how the rate's going up? The rate's going up because the risk is going up for the bank. The car has 4 wheels. It moves around. If the bank has to foreclose or go find and repo this car, they got to drive around and find it. A little bit more work, but not a lot. So the car dealership gets the money when the bank finances the car, and the car dealership puts it back into the bank. Round and round we go. Bank takes that, lends it back out to somebody that wants to do some home remodeling. And maybe that's in a form of a home equity line of credit. So what the bank does is they look at that original house, they say, hey, you got a bunch of equity there. We'll issue a line of credit on that equity. We're going to take a second position, sometimes a first position in a first lien HELOC, and we're going to give you that money in the equity. But we're going to charge you 9%. These rates aren't too far off of where we're at right now. The remodel costs money. Contractors get the money, they put it back in the bank, and the bank immediately lends that money back out on another loan at 12%. See, we went from they're paying you 4%, charging 7% for the mortgage, lower risk, charging 8% on the car, a little bit higher risk, charging 9% on the second position home remodeling loan or HELOC, and then charging 12% on a debt consolidation loan because that is probably the highest risk the bank wants to take. The credit cards get the payoff because the bank doesn't give the person who's in debt the money. No. The bank pays the money direct to the credit cards because this is how they cash flow it. The credit cards take the money, put it back in the bank. So this is banking 101. I didn't want to make this complicated, but you can see it all started with them convincing you, me, and everybody else that what we need to do with our hard-earned dollars is take that money and give it to the bank, deposit it in the bank. And we do this very effectively. Matter of fact, today, your paycheck, I bet, goes directly into a bank account. Now, let me ask you a question. How much interest are you getting on your checking account? 0? Like me? Yeah, I bet. Now, let's just run through this spread that the bank's making. 4 minus 7, okay, that's spread number 1. 4 minus 8, spread number 2. 4 minus 9, spread number 3. 4 minus 12, spread number 4. If we add all those spreads up, you realize that comes out to be 20%. Do the math. It's simple math. 20%. The bank made 20, you made 4. The bank made 20% net, you made 4. Now, what do I mean by that? Well, when I ask people how much more did the bank make than you on the money you leave in the bank, most people would take the 20 and subtract the 4, but we already did that. Because remember, I did 4 minus 7, 4 minus 8, 4 minus 9, 4 minus 12. I know this is getting repetitive, but just understand the bank made a net of 20, you made 4. If we divide 4 into 20, the bank made 5 times more than you did. And if you go to a website called BauerFinancial.com, you can look up any bank for any time frame, and you will see that banks make 400 to 1,300% more than you do on the money you leave there. So now the simple question is, what is it that you want to do? The answer should be you want to be the bank. You want to make the spread. You want to take back control of your money. And that is exactly what we're going to get into with the infinite banking concepts. So change your mindset around money. That's the biggest ask. This is not about a product. We are going to include a product because you cannot control your money if you keep putting it into their bank. You need to change the dynamics so you are in control, and the only way you're going to do that is by changing what kind of institution your money gets deposited in. But let me be very clear. The infinite banking concepts, or commonly known as privatized banking throughout history, is simply the process of you taking back the banking functions in your life. Now, let me pause before we go into the infinite banking concept. I want to ask you for a really, really simple favor. You see this little button? It says subscribe. Please click that subscribe button so that I can keep growing this channel and helping people take control of their finances. And also, there's a little bell up top. What I would love for you to do is that thing, you smash that bell. Yeah, that was this thing right here. What you're going to do, you're just going to smash it, and then it's going to notify you every time I put out new, content and all sorts of new lives. So let's dive in. Again, one of the most important things for you to understand is that you're going to finance everything throughout your life. Your capacity for financing is far greater than the capacity for anything else with your money, because that's the world we live in. We finance our cars, we finance our houses, we finance our lifestyles. So wouldn't it be nice if we're going to finance everything? Wouldn't it be very nice if we were on the right side of that? If we were on the control side where we are the ones earning the spread. We're the ones making all the money for the financing. Now, I want to preface this. The infinite banking concept is not a get-rich-quick scheme. It is not a scheme at all. It is simply a process, and one that does take time, because if you were to open a bank tomorrow, you would have to capitalize the bank. You'd have to save up money. You'd have to invest in the real estate for the bank location. You'd have to go out there and capitalize your bank. Well, you're going to have to do the same thing here. But let me show you how that works. Over here, you all have an income. That's the beauty. We're all working. We're trading hours for dollars, running our businesses, doing our side hustles. That income comes in, and what do we do with our income? Well, most all of us have that income go into a checking account. And then from the checking account, several different things happen, which I'll cover in another video. But some people take some of the money from the checking and they put it into their savings. This is where the concept comes into play. We're not talking about redirecting all your income, because from your income in your checking account, you're going to make all your bill payments, you're going to pay your rent, you're going to buy diapers and all that stuff. That's all staying the same. But I'm talking about redirecting just one thing, and that is where your savings goes first. That's it. Just the amount you would save. Now let's dissect savings just for a second. A lot of people's savings, some of it goes to your 401k. Now, in some cases, not all of you, but some of you, you're going to have to reduce the amount you put into your 401k, because a lot of you are trying to put so much away into something that is way down the line called retirement, like 59.5 is the magic number, while today you're living buried in debt, you're living paycheck to paycheck, and you don't even know what's wrong. It's the order and how you're doing things. It's how you're looking at money. You're focused on a fictitious thing called a retirement when you should be focusing on the now, which is what we're going to do today. The now is we're going to redirect your savings into your own banking system. Now, what is your own banking system? I already alluded earlier, it is not a traditional bank. It has to be a different institution. Now, where this came from, it came from the Rothschilds, the Rockefellers, the Morgans, the Stanleys, way back when they needed a better place for their wealth because banks weren't stable. And what did they find? I know this is going to sound crazy, but they found that the most financially stable institutions were none other than mutually owned life insurance companies. But when they went to the life insurance company to say, hey, we got this money, we want to make deposits into your institution, the life insurance company said, we're not a depository. So they figured it out. And they figured it out with a product that has been around for hundreds of years called whole life insurance. Now, this is where the product discussion comes in, and this is also where the product discussion will end. I simply want to explain, why is it that specially designed and engineered whole life insurance policies are what should be used to operate your private banking system, to operate your infinite banking concepts solution? Well, Here's why. Because the insurance companies, the specially designed and engineered whole life, now I want to preface, this is not a normal whole life. This is a whole life that is built and constructed completely different than the one your advisor or life insurance agent is probably trying to sell you. It is contractually engineered differently, so it has high early cash value. Now, a couple things. Life insurance, or whole life insurance specifically, you, in a contract, get a guaranteed interest rate. That is the first and most important thing we need to understand. In the bank, you might be getting interest on your money, but it is not guaranteed to stay there. In the contract, a contract with a mutually owned life insurance company, in the whole life, you are guaranteed an interest rate. And today, those interest rates vary, but they can be anywhere between 3 and 3.75%. Now, that's nothing to get excited about, but it's probably better than what your bank's paying. But you see, I mentioned they're mutuals, which means they are not publicly traded companies. They are mutually owned, which means the policyholders, you, if you buy one of these whole life policies, you are technically an owner in a roundabout way. They share that ownership through dividends. So not only do you get guaranteed interest, you get dividends on your money. And you know, here's the cool thing. The dividends are not guaranteed, but they have never, ever not paid one. They paid them through the Great Depression, through the Great Recession, through COVID. They've never missed one. And today, if we add the guaranteed interest with the dividends, they call it a dividend crediting rate. Look it up. Dividend crediting rate. Right now, you're going to get 5.9 to 6.6. Now, let me make mention, because this could change in the future. This is March of 2026. These are the companies that we're dealing with. On top of that, the guaranteed interest and dividends, if the policy is designed properly, which we definitely know how to do that. If you're interested, click the link down below to book a call. We can kind of run one of these scenarios for you and show you what they look like. But if it's designed properly, the internal buildup of the cash value, your high early cash value, grows tax-free. So now you can go back and you can look at 5.9 or 6.6 and figure out what is the after-tax yield equivalent. How much would you have to make in your bank account or in a taxed investment to earn that? It's a lot more. Anyway, let's keep going. On top of all of these other things, the guaranteed interest, the dividends, the tax-free growth, is protection. In most states in the United States of America, and I believe partially in Canada, you are protected from judgments and liens, which means if you have a specially designed whole life or any life insurance for that matter, your cash value has protections. Check your state to make sure that it has these protections, but most states are protected against judgments and liens. So now your money's protected, okay? It's not only protected, it's probate free. It does not have to go through probate. It bypasses it and goes direct to your beneficiaries. I know this is all boring, but then the last thing, listen, for any of you that actually have a family, I have a little girl, I have a wife, I have a family. If something happened to me tomorrow and I was no longer here, I want to leave them in a better place. And there is no better way, no more efficient way to do that than by leaving a death benefit from a life insurance policy. So all of these policies have a death benefit. Now, if you don't care about your family, well, this probably isn't for you. You can just go watch another car video or something else. But for those of you that actually love your family, this can be a really important thing. But I'm going to get into why it's even more important now. So let's switch from the product, because the reason I wanted to call all these out is you have to understand the reason why specially designed whole life is what you use for the infinite banking concept is it's simply a better alternative than anything else. Hey, one other thing before I move on to the process, and this is really important. Before you run out to your financial advisor, your buddy who sells life insurance, I want you to know something. In order to design and engineer this policy for high early cash value, we or your advisor or agent will have to give up 60 to 90% of their commission so you have 60 to 90% more cash value. I'm just warning you, they're not going to want to do that. They're not even going to know how to do that. And they're going to tell you it can't be done. But it can. You see, I spent 16 years as a financial advisor and no one ever told me about this. So why would you think that your advisor is going to know how to do this? But it can be done, and it is done. And we do this for thousands of people nationwide, and I'd love to help you with it. But let's get on with this, because so many people want to focus on selling you a product. And what I want to do is I want to show you how the process, called the infinite banking concept, will solve your financial problems. That is the purpose of today's video. Taking back the banking functions in your life. So remember, we're changing where your savings is going. So let's just say that you are saving 10% of your income, which would be really good. 10% of your income, and let's just call that $10,000 a year. Now, the amount you save, that's completely up to you. When we design these policies, we're going to design it around the amount you want to save, not the amount we tell you, not the amount we think you should be putting in, just what you say. You might tell us, hey, I'm saving $500 a month. Can this work? Yes, it can. Hey, Chris, I'm saving $500,000 a month. Yes, this works for you too. There is no right or wrong amount. There is just your amount. So whatever that savings is, we're going to change one thing, and that is where it goes first. We're going to put it into this specially designed whole life, but it is not going to stay there. This is the common misconception. You see, the way we design this, you will have access to your cash value immediately in the first 30 days when your check clears. Now, that is not normal. A normal whole life, and I got another video that shows this. If you want to watch it on my YouTube channel, again, click that subscribe button, check out the video on how to design an IBC policy. But the way this is done is you make a deposit into the policy instead of your bank. When that deposit clears, we always say immediately in the first 30 days, you will have access to your cash value, and we will show you how to use it. We're not just selling products, we're implementing strategies. We're solving problems. There's a huge difference. When that money goes in, remember we're just using this, you're going to put $10,000 per year into this policy for this example. Now, over here, I want to just kind of show you this circle. This is what we're trying to emulate. Remember that circle I showed you in the beginning with the bank? We want to go round and round the circle, but we want to be in control of all of that. And you will be by the time I'm done. But we need to understand the process and why we do what we do. When we go into our policy and we take this money out, you can take it out two different ways. Technically three, but let's just talk about two. You can do it the way you would take it from a bank. If you put 10 grand into a bank and you take a withdrawal, how much money is left in your bank when you take all the money out? Zero. Okay? Same thing with the policy. If we put 10 grand into the policy and you withdraw all the cash value, there's no money left in the policy. So we're not going to do that. Here's what we're going to do. We're going to operate the same way a bank would with a home equity line of credit. You have equity in your house, you get a home equity line on that, and you borrow money from the bank. But your equity in your house is still there. Your equity is still increasing if your house is appreciating, so you just get to use that equity. Well, this is the same, but here's how it works. You see, when we put this money in, let's just use $8,000. We're going to take $8,000, and I'm going to show you where that money is going to go in a second, because there's a purpose. There's always got to be a purpose, because remember, you're either giving up interest on the money by taking withdrawals, or you're paying interest to somebody else. Today, I'm going to show you how to recycle and recapture money that you're paying to other people, and I'm going to show you, mark this down, write this down, I'm going to show you how to build wealth the most efficient way possible through your own debts and expenses that you already have, without changing your cash flow, without you working any harder, and without you taking on any additional risk. That is what we're going to learn. But we're going to do this a very non-conventional way. We put 10 grand in. We need $8,000 because we have a massive opportunity over here in this opportunity box. In this opportunity box, for all intents and purposes, is you have debts. The greatest opportunity of your lifetime to build wealth is through your debts. I'm going to show you how to do that because your debts represent holes in your boat. Every debt you have represents a hole in your boat. Let's just think about it. The credit cards every month, your boat is leaking. Monthly payments. Your car payment every month, leaking. Okay, your mortgage payment every month, leaking. Your student loans, leaking. Get the point? Those are leaks in your financial system. We're going to plug those. And here's how we're going to do it. We're going to take a loan from the life insurance company. And I know you're thinking, oh my God, Chris, that sounds the stupidest thing I've ever heard. You mean I'm going to change where my savings goes so that I can borrow it from the life insurance company? Yes, because let me show you why. Remember the math. Let's just use 6% for all intents and purposes for right now. Now, this is not the number. I just want to give you a reference point to go on. 6% is what you're earning in dividend crediting, okay, which is the guaranteed interest in the dividends. Just remember that. We're going to take $8,000. Now, let's say we find a life insurance company that will allow us to use their money at a rate of 5. You're earning 6, and they're charging you 5. Now, just to kind of put that into perspective, let's say you found a bank You could go into that bank and you could deposit your money in that traditional bank and they paid you 6% on your money. But you could go back into that bank, no questions asked, and they would give you a loan at 5%. How many of you would take that loan? Just be honest. You're making 6 and you can borrow at 5, and that's it. Those are the only rules you need to understand. All of you would borrow at 5 and still continue making 6 because you'd be making what? The same thing a bank. You'd be making a spread. That is the whole idea, except not many of you got too excited about a 1% spread, and I get it. But what if every year your spread got bigger? And it will. It will because of what I'm going to tell you next. So pay attention. This is one of the most important things I can tell you. If your cash value in your whole life insurance policy is compounding, and it is, it's compounding with guaranteed interest and dividends. That means next year it will have more money than it did this year. And if that compounding is mostly guaranteed, which I explained that it is, now all of a sudden you can be guaranteed that next year you'll have more money than you did this year. And the year after that you'll have more. And compounding is a really interesting thing. Albert Einstein said it's the most powerful thing in the universe. Those who understand it earn it. Those who don't pay it. Now, let's talk about that. When you compound your money, you're earning interest on top of interest over time. That's what we're doing here. But you see, unlike a bank, the reason we can do that is because the insurance company is allowing us to use their money. And insurance companies have lots of money. Banks, not so much. Banks have our money. It's not their money, but they're using our money. Insurance companies, they have their own money. It's called their general account. Look it up, Google it, ChatGPT it. How much surplus do life insurance companies have? And then ask, how much surplus do mutually owned life insurance companies have? The ones we deal with can be into the hundreds of billions of dollars of money just sitting there to guarantee the payout of future benefits that they promised, which is the death benefit. We're all going to die, folks. It's just the insurance company has to know how much they need over the course of time to pay out on those death benefits. So this is the really cool part. The life insurance companies will let you borrow part of your death benefit while you're living, as long as you've got the money and cash value to collateralize it. That's the key word. So if you had 10 grand in cash value in your policy, the life insurance company will usually let you take about 90% of the 10 grand in loans. And that is them giving you, right here, they'll give you a loan against your future death benefit. Think about that. It's brilliant, isn't it? Your death benefit's going to be paid out when you die. The insurance company knows that. They have that money set aside. So why not let you use it while you're living? But why not use that money and make a spread on it? You see, remember, I'm going to hit this one last time. Your money's still compounding. All of your cash value, in this example, if you had $10,000 in cash value, all of that is compounding, regardless of you taking the $8,000 out. The difference is you got to pay 5%. Now, this is important. Simple interest. They're charging you simple interest. And the insurance companies, almost every one we work with, charge you interest one time per year on your policy anniversary. It's not like your home equity line of credit where every month you're going to have to pay interest on that money borrowed. They charge it one time because it was in advance of your death benefit while you're living, collateralized by, yes, your cash value. Now, I know I went long on that. But that is a really important thing because this is how banks make money. They make a spread. I just showed you how to reverse that role. I showed you how to be in control of your money, and I showed you how to do what a bank does by making a spread. And I'm going to show you in just a second how that spread every year is going to go up because you're compounding here, but then we're also going to be paying the loan down. We're going to be using money you're giving away today to pay that money down. Now let me come over here and show that. Remember I said the biggest opportunity over here is your debts. So we take this loan. That loan from the insurance company is deposited into a bank account. Now, the way we teach this, and I think this is really important, is we're going to have you go to your regular traditional bank and open up a second checking account. We're going to call this your segregated bank account. It is just a bank account. The reason it's segregated is we want to track our privatized banking activity. So this $8,000 loan that came from your policy is now in your bank account, to which we're going to then deploy that for opportunities. This opportunity I'm going to give you is a very simple one. All right, so we've got the $8,000 in the bank. We've got some credit card debt. $4,000 in credit card debt across a couple different credit cards. The average interest rate we're paying on those credit cards is 20% for an example, and your monthly payment you're making is just the interest payment at $100 a month, which means you're not paying the balance down, you're just covering interest. Then you've got a car loan that you've been trying to knock out. You only owe $4,000 on that. The car loan interest is only 5% interest, and your car payment's $350 a month. So this represents a very big opportunity. Matter of fact, I just worked with a doctor the other day and we did something very similar. This doctor had a credit card debt and his interest was just about 20%, and he had a little bit left on a car that he was trying to get paid off, and he was aggressively making extra payments. So I showed him how to do this, and he couldn't believe how efficient it was. So watch. With this, every month, you are giving $450 of your income away. It's leaving your family forever. What do you have for that? Nothing for the credit cards or whatever they bought, and then you've got a car. But you're losing $450 a month. You're also giving up 12.5% interest. Now, some of you are like, well, how'd you come up with that? Take the 20% for the credit cards right here, okay? And then add that to the 5. So you have 25 and then divide it by the two debts. That's 12.5%. That's a pretty good return, right? Think about your 401k. Think about your investment accounts. Wouldn't you like to make 12.5% on that money that you have invested? You would love that. But what if you could make 12.5% guaranteed? No risk. You'd love that even more. Well, this is your opportunity right here. So what we're going to do, we're going to take that $8,000 right here that was in that segregated account, which came from the loan you took from the insurance company. Remember, that loan is costing us 5%. We're going to then come over here and we're going to pay off the credit card and we're going to pay off the car loan. $8,000 came from your policy, paid off your debts. This is one of the most important things not to forget. You are not done, because that would be stealing from your bank. You took money from your bank to pay off their bank. You used to pay their bank $450 a month. You used to give their bank an average of 12.5%. You are worth more, which means you're going to pay that exact same amount back to your banking system, but you're not going to lose the money anymore. You're not going to give up control of that money. That money is not going to flee your family ever again. And here's how. The $450, which represents $350 from the car payment, $100 from the credit card. Let's just write this down here. That's $450 every single month. Same cash flow, folks. You didn't give up any cash flow. This is exactly the same amount you were paying to those debts prior. Now what you're doing is you're paying them back over here to this segregated account. So every month, $450 a month goes into this account. Now, after that, what we're going to do is we're going to get a form from the life insurance company, and we're going to recycle and recapture that $450 that is in their bank, okay, your segregated account, and we're going to put it back into your bank. So we're going to fill out a loan repayment form. We do all this work for you. Okay, we even have software that runs this entire process, because some of you are like, oh, that's a lot to do. What if it was like GPS in your car? You all know how to enter an address in your GPS. Well, here the address was, I want to pay off my debt. That's what you put into our financial GPS, which is called the Vault. And the Vault will run this. But $450 now goes back into your policy. Now, let me explain something that happens here. This is really important. So remember, before we were all about the spread. So now we're going to talk about how we're going to increase that spread on top of what you were doing before with compounding interest. $450, when it hits the policy as a loan repayment, you have $450 the next day. You didn't lose that. The way you were doing it before, this $450 was gone forever. Now, it's just in your cash value. Dollar for dollar, you have $450 every time you put it back as a loan repayment. But every time you do that, you are also subtracting $450 a month from the $8,000 loan you took from the insurance company. So let's just go through this really quick, because I know it's a lot of numbers. Again, the Vault software will do all this for you, but it's important you understand. If you're putting $450 back into your policy as a loan repayment, every month $450 is reducing the loan amount. So let's just do this yearly. We started with an $8,000 loan from your policy that had $10,000 in it. you're still earning interest and dividends on the full $10,000's cash value. But you used the $8,000 to pay off these 2 credit cards. You recycled and recaptured the money you were giving to the credit card and the car payment of $450. That's the same as recapturing and recycling 12.5% in interest that you were giving away. That $450 comes back into the segregated account and then flows through into the policy as a loan repayment with one form that we fill out, and then it's automated. Now, here's the math. $450 times 12 is $5,400. If we take 8 minus 54, that gives us roughly $2,600, I think, if my math is correct. Now, if we just think simple interest, the insurance company was charging us 5% on $8,000. By the simple math, that's $400. So year one, if we never paid this loan back to the insurance company would have charged us 5% on the $8,000. That's $400. But now, all we did is we were honest bankers. We didn't steal from our banking system, and we redirected that $450 we were giving away back into our control, back into our policy. Remember, you didn't lose any liquidity of the $450. It's in your policy, but it's still counted against your loan. Now, if we do that, $400 is what you were paying. What is 5% of $2,600? It's $130. Would you rather pay $130 in interest versus $400 in interest? Now, remember, your full cash value is earning interest at whatever your dividend crediting rate is, okay? Minus cost and expenses, and that's simple. We can run all that math for you. That would be cost of insurance for the death benefit, the commissions, which are reduced 60 to 90% depending on the build, and then also a policy service fee. But you're still making a heck of a spread. And then, how long are you out of debt in? Well, about a year and a half. Okay, if we did the simple math, a little over a year and a half, and you are debt-free, which means all the money's back in your policy. Okay, every penny of it is paid back to your policy. So now that $8,000 is expired, you no longer owe that. You have the $8,000 in here, plus all the interest you earned on the compounding side of it, plus you made a bigger and bigger spread every time you recaptured money. This is the infinite banking concept. You took back the banking functions in your life. Now, I only showed this with 2 debts, but replace that and put all your debts in there. Put your mortgage in there when you're done. You pay your debts off the simplest way from lowest balance to highest balance. We organize all that for you. Or let's just say you wanted to look at opportunities outside of debts. Maybe you don't have any debt. Maybe you're a business owner, but you finance equipment in your business. Well, let's redirect that. Let's stop borrowing from finance companies and start borrowing from our private banking system. If you want to invest in real estate, let's borrow from our private banking system to buy real estate. You see, if it works for debts, what else does it work for? Everything. It works for everything. All the while, you have protected your family. Your family, if you die, is in a better place than where they are today. So it's self-completing. You've taken the risk out of the equation, you've taken back control of your money, and you have applied a concept that has been around for a very, very long time, hundreds of years, used by the wealthiest families throughout history, so that you now can think about money differently. And all the money that is leaking your life, leaking your financial system, is now right there where it should be, in your control. Folks, this is the infinite banking concepts. And I hope you understand this, because this will change your financial life. This will change your family's financial life. And this will change the way you do and finance everything throughout your life. Hey, if you've liked this video, I think you're gonna love this one right here. BYO Bank. Be your own bank. Check it out. We'll see you on the next one.